There's a law that governs every age of prosperity, a law older than any empire, older than greed itself. When crowds believe they've found a formula for endless wealth, that is when the countdown begins. Every boom is a promise, every crash a reckoning, and in between there are always two kinds of people, those who see and those who sleep. The smart money always moves first. While newspapers chant optimism and politicians toast to progress, a small circle of insiders is already heading for the exits. They don't believe in new eras. They believe in cycles and the mathematics of fear and euphoria. They recognize the smell of smoke before the crowd sees the fire. In the 1920s, America was hypnotized by the sound of its own success. Factories roared, radios crackled with jazz, and stock tips and Wall Street became a cathedral of faith in the future. Stock prices didn't just rise, they soared. Companies with no profits were valued like gods of industry. Ordinary families mortgaged their homes to buy shares in a dream they couldn't afford to wake from. Every corner of the country was infected with the same fever. A shoe shine boy talked about General Motors. A housewife borrowed money to buy Radio Corporation of America. A taxi driver explained market trends to a banker. The illusion was complete prosperity had become a mass delusion. But somewhere in a quiet office overlooking the chaos, someone was watching differently. Joseph Kennedy, the future patriarch of America's most powerful dynasty, began selling while others were still celebrating. He didn't act on gossip, he acted on pattern. He knew that when everyone borrows to get rich, wealth turns into debt disguised as hope. Across Manhattan, Bernard Baruch, the veteran of panic's past, was making similar moves. He remembered 1907, the same overconfidence, the same borrowed frenzy. By the summer of 1929, Baruch had liquidated most of his positions, sitting on cash and bonds, while the world mocked his caution. He called it the loneliness of foresight. And then there was Jesse Livermore, the man who turned panic into profit. He studied the psychology of crowds, not their words, but their rhythm, the speed of greed, the pulse of fear. He wasn't escaping the crash. He was preparing to feed on it. They all saw the same storm forming. Interest rates were rising. Margin debt had reached the sky. European investors were pulling out quietly, sending their capital back across the Atlantic. Corporate insiders were dumping stock while publicly preaching confidence. To the trained eye, it was a perfect alignment of doom. But the public? They believed this time was different. They always do. And so the stage was set. October 1929, the month when optimism met gravity, the final dance before the fall. The smart money had already vanished into the shadows, leaving the rest to face the music alone. And now, a century later, the pattern begins again. History is not chaos, it is choreography. Every financial empire follows the same rhythm: exuberance, leverage, denial, collapse. The faces change, the technology evolves, but the structure of human belief remains identical. The 1929 crash was not a tragedy of ignorance. It was a tragedy of arrogance. The signals were there, written in bond yields and credit spreads and the quiet movements of gold across oceans. But nobody wanted to read them because doing so would have shattered the illusion. The truth was, simple prosperity built on debt is not prosperity at all. It's time-delayed destruction. When capital stops flowing from productivity to speculation, the economy becomes a machine that devours itself. People stop building. They start betting. Banks stop lending to industry. They lend to gamblers. And when the gamblers lose, everyone pays the price. This is the hidden law of financial civilization. Credit creates empires, but leverage destroys them. By 1929, the American economy had become a tower made of mirrors. 40% of all stock purchases were made with borrowed money. Investment trusts borrowed from banks to buy more stocks, often in other trusts that were also borrowing. It was a self-referential spiral of leverage, a pyramid of promises balancing on air. The higher it climbed, the more magnificent it appeared. But the higher it climbed, the closer it was to gravity. And yet optimism drowned every warning. When the Federal Reserve raised interest rates, people called it a pause before another boom. When margin calls increased, they called it a buying opportunity. When foreign money left, they called it patriotism. The crowd does not see because it cannot afford to. It believes not what is true, but what is comfortable. Meanwhile, the insiders, the ones who understood cycles, were reading the signals like a prophecy. To them, the rising rates were not numbers. They were omens. The insider selling was not coincidence. It was confirmation. The volume spikes, the credit strain, the frantic optimism, all were echoes of earlier collapses. Rome, Amsterdam, London, the same fever, the same fall. When everything becomes speculation and information loses meaning. No one can distinguish value from price risk, from reward signal, from noise. It is in this blindness that the cycle completes itself. Because every system inflated beyond reason must correct, and every crowd that believes it can escape history becomes its next example. This is the lesson Wall Street forgot and Main Street never learned. The market is not about growth, it's about gravity. And in 1929, gravity reclaimed its debt. History proves it again and again. Every collapse follows a hidden mechanism, a repeating sequence that has destroyed empires, dynasties, and markets alike. The pattern unfolds not in days, but in phases. And in 1929, each stage played out with surgical precision. It begins quietly in optimism. A new technology, a new idea, a new century. In the 1920s, it was radio automobiles and the illusion of infinite growth. Factories multiplied. Wages rose. Newspapers celebrated a permanent era of prosperity. Capital poured in from Europe, chasing American returns that seemed to defy reason. Politicians promised that poverty itself would soon be eliminated. The Dow Jones doubled, then tripled. Every household became an investment firm. But behind every boom lies a debt. The foundation of this prosperity wasn't industry, it was credit. Banks lent money not to builders, but to speculators. And the more people borrowed, the higher prices climbed, creating the illusion that the system itself was safe. The illusion was perfect until belief replaced discipline. Picture this. The streets of New York glittering under neon lights, stock tickers humming like a heartbeat while deep beneath the foundations start to crack. By mid-1929, the insiders had already begun to withdraw. Joseph Kennedy sold quietly long before the first headline appeared. Bernard Baruch moved into government bonds instruments of survival, not ambition. Jesse Livermore built short positions, large enough to bet against civilization itself. They weren't reacting to panic. They were reacting to mathematics. When leverage exceeds, growth collapse becomes inevitable. Meanwhile, the crowd laughed at the cautious few. Financial journalists mocked pessimists. Radio hosts reassured listeners that the market was merely correcting. Even the president declared, the fundamental business of the country is sound. The paradox of every mania is that the more fragile it becomes, the more confident the crowd grows. Every warning becomes proof of jealousy. Every doubter becomes the enemy. But the insiders knew what was coming. They watched as margin debt reached record highs. They saw European gold flow back across the Atlantic. They noted the tightening credit, the silent selling from corporate insiders. The storm was already gathering, and yet the city danced beneath clear skies by the time they realized it was too late. October 28th and 29th, 1929. The reckoning. It began not with fear, but with disbelief. The first wave of selling was dismissed as temporary. But when margin calls hit, disbelief turned to panic. Phones rang unanswered. Brokers screamed across trading floors, drowned in chaos. Wealth evaporated faster than thought. In 2 days, billions of dollars in paper profits became ash. But the smart money was not screaming. They were silent, calm, executing plans written months before. Livermore's short positions exploded in profit. Kennedy's liquidations were complete. Baruch's bonds rose in value as the world collapsed around him. For them, the crash wasn't chaos, it was confirmation. Every trade, every decision, every warning they had read, all vindicated by destruction. For the rest of America, it was the sound of gravity reclaiming what greed had borrowed. Factories closed, banks failed, families lost homes built on illusion. The radio, once a symbol of progress, now carried only the static of despair. This was not an accident. It was the cycle fulfilling itself, the mathematics of mania, collapsing into silence. The pattern had always been there. 1. Euphoria belief without reason. 2. Leverage profit without foundation. 3. Denial warning without action. 4. Collapse consequence without mercy. And yet, with every generation, humanity forgets until it remembers too late. History doesn't repeat, it evolves, and the next stage has already started. A century later, the world has changed beyond recognition, yet the pattern remains identical. The same illusions, the same blind faith, the same music playing before the fall. We replaced ticker tapes with digital screens, brokers with algorithms, and crowds with data, but the psychology, the heartbeat of every boom and bust, is still human. The decade leading to 2025 became the modern echo of the 1920s. A new technological age promised to redefine humanity. Artificial intelligence, crypto-electric vehicles, each became its own religion. Investors no longer spoke of profit. They spoke of disruption. They no longer asked if a company earned money, only whether it had a story. Valuations detached from reality. Tech giants surpassed the GDP of nations. Startups with no revenue were priced like empires. The old wisdom of cash flow and prudence was replaced by the gospel of infinite scale. Debt once feared became strategy. Governments borrowed to sustain the illusion of growth. Corporations issued bonds to buy back their own shares, feeding an artificial rise in prices. Households spent beyond their means, reassured that inflation and interest were temporary. The same delusion that fueled the roaring 20s now ran on code and confidence. Social media amplified greed into gospel. Financial influencers became the new oracles, selling optimism disguised as insight. The crowd no longer met in cafes or stock exchanges. It gathered in digital temples chanting, "This time is different." But it never is. Even as inflation spiked and global debt crossed unsustainable thresholds, the crowd chose comfort over clarity. Every warning from tightening liquidity to slowing growth was reinterpreted as opportunity. When history rhymes, denial always writes the chorus. And, again, the smart money moves quietly. The world's largest asset managers shift from high growth equities to hard assets, energy, minerals, agriculture. They see what the crowd cannot, that paper wealth dissolves faster than rain. Executives sell stock options while reassuring investors that the fundamentals remain strong. Governments repatriate gold reserves and reduce exposure to the dollar, just as European banks did before 1929. In the corridors of power, whispers replace speeches. Interest rates rise, liquidity dries up, yet optimism continues its final ascent. Bond markets, the silent prophets of finance, begin to scream divergence. Stocks climb as yields rise in impossible balance that history has never allowed to last. Foreign capital quietly leaves overvalued markets. Insider sales reach record levels. Still, the crowd dances hypnotized by charts that always point upward. The same misbelief unfolds that risk can be managed by mathematics, that markets can defy gravity, that human behavior can be coded away. But the algorithms, for all their speed, have no memory. They cannot remember 1929, 2008, or any of the 1,000 panics that came before. They simply mirror the crowd accelerating emotion instead of wisdom, and when panic comes, they will amplify that too. 2025 stands on the edge of another turning point. The signs are subtle as they always are before the storm. Nations hoarding commodities instead of currencies. Corporations cutting costs quietly while projecting optimism publicly. Central banks trapped forced to choose between inflation and insolvency. Populations growing restless as inequality widens and faith in institutions thins. These are not isolated events. They are fragments of the same cycle, a global repetition of 1929's pattern under a digital disguise. The public sees innovation, the insiders see exhaustion. The public hears recovery, the insiders hear tightening. The public wants miracles, the insiders prepare exits. History's rhythm beats beneath the noise: euphoria, leverage, denial, collapse. The tempo quickens each time. The tools change from stock tickers to quantum computers, but the weakness remains the same belief in permanence. And, as in every age before, those who understand the pattern are already acting. They are liquidating positions, converting wealth to tangible stores of value, diversifying across borders and systems. Because the rule has never changed, not in 1720, not in 1929, not in 2025. When the crowd believes it can't happen again, that's when it already has. Look closely and you'll see it, the same glow of false prosperity before the dark, the same confidence that precedes collapse, the same silence before the storm. We are not in a new era. We are in the same story, rewritten with new names, new numbers, and the same inevitable ending. And history is waiting patient, unblinking for the next October. History doesn't crash, it corrects. It restores balance after humanity stretches too far beyond reason. Every generation believes it has outsmarted gravity, and every generation must eventually learn that gravity never sleeps. The crash of 1929 was not about numbers. It was about faith, and endless progress, and the permanence of prosperity, and the myth that intelligence can replace discipline. That faith has returned, dressed in the language of innovation and data. But behind every new tool, every new promise, the same fragile psychology beats beneath the surface. Human beings do not build markets, they build mirrors. Each age projects its desires onto its own reflection, and when that reflection becomes unbearable, the mirror shatters. We call it a crash, but really it is revelation. The law of cycles. Every empire of wealth, whether a nation, a company, or a civilization, obeys one law, the law of diminishing wisdom. Prosperity breeds complacency. Complacency breeds arrogance. Arrogance breeds collapse. It was true for Rome when senators believed marble would outlast debt. It was true for Britain when global trade masked internal decay. It was true for America in 1929 when credit became culture. And it is true again today when speculation masquerades as progress and the architecture of finance rises higher upon foundations of sand. We think we've evolved because we have algorithms, but the pattern remains human. Fear and greed are constants, only the vocabulary changes. Where Kennedy once watched ticker tapes, today's insiders watch liquidity dashboards and bond yield curves. Where Baruch saw panic in crowded trading pits, modern investors see it in server latency and volatility spikes. Different tools, same psychology. The data may be infinite, but wisdom is finite. And when markets grow faster, then understanding collapse becomes the teacher. The historian will tell you that 1929 was an event, a singular moment when optimism met ruin. But the truth is subtler and darker. 1929 never ended. It simply changed its costume. It reappeared in 1987 when program trading triggered panic at speeds no human could comprehend. It whispered through 2000 when dot-com dreams replaced sound business with spectacle. It screamed again in 2008 when derivatives transformed mortgages into weapons of mass destruction. And it hums once more beneath 2025 in artificial intelligence, stocks, speculative assets, and the illusion of safe risk. Each time the crowd swears, "This is progress, not mania," each time the smart money moves first, and each time the cycle fulfills itself, not through randomness, but through rhythm. History does not repeat, it synchronizes. You can map every empire's heartbeat by the same pulse: excess, denial, correction, renewal. The correction is never cruelty, it's maintenance. Civilization requires collapse because growth without limits becomes rot. In 1929, that truth arrived with silence, the silence of phones gone dead, of fortunes erased in seconds, of streets emptied of laughter. In 2025, it may arrive as a digital silence screens, frozen data feeds, stalled liquidity, evaporating faster than thought. Different form, same fate. Every generation inherits two legacies: the wealth created by its parents and the ignorance they refuse to surrender. In times of abundance, history becomes entertainment. We study it in comfort, confident it cannot touch us. But when the pattern turns, it stops being academic, it becomes personal. The tragedy of 1929 is not that people lost money, it's that they lost memory. They had read the same stories from centuries before, of tulips, of railways, of South Seas, of silver mines, but they believed theirs was a smarter age. Now we say the same. We tell ourselves that technology will save us, that governments can engineer perpetual growth, that algorithms can erase fear. But no machine can rewrite the laws of consequence. No innovation can program humility, and no system can outthink the human heart that feeds it. We mistake complexity for control, but complexity is simply a more elaborate stage for the same play. The actors change, the ending doesn't. The greatest illusion of every empire is the illusion of permanence. The lights of Wall Street in 1929 were as blinding as the glow of our screens today. Back then, prosperity was measured in ticker tapes, now it's measured in terabytes. But both are signals of the same disease, the belief that progress can be infinite, that gravity is optional. It never is. Empires don't fall from invasion, they collapse from exhaustion, from within, from the slow erosion of values beneath the weight of excess. The crash is not the end, it's the sound of limits reasserting themselves. And, so the prophecy stands, when optimism becomes arrogance, when debt replaces discipline, when warning becomes mockery, the countdown begins. In that moment, history leans forward and whispers, "We've been here before." Then, as always, the smart money moves first. The insiders retreat. The crowd dances louder. And somewhere in the hum of servers and the pulse of digital markets, you can hear the faint echo of 1929 reminding those who listen that prosperity without prudence is only the prelude to silence. So remember this. Markets reward patience, not panic. They reward knowledge, not noise. They reward those who study history, not those who ignore it. Because history is not punishment, it is balance. And when balance returns, it does not knock, it breaks the door. Empires never fall from outside, they collapse from within. And the next collapse has already begun, not in the market, but in our belief that it never will.